Samuel Leeds says it could be impossible to buy property by 2030. That's a big claim, and big claims deserve scrutiny. He's built a successful business around renting property and property education. So when he warns that banks are accumulating property at scale, it's worth asking who benefits when people believe buying property is impossible. In this video, I'm not attacking Samuel and I'm not defending the banks. I'm breaking down the numbers, the language and the incentives. And then you can decide whether this is a genuine warning or a very effective piece of marketing. So let's get into it. Everything in this video is my personal opinion based on publicly available information and my interpretation of the content shown. I'm not making any factual allegations or accusations against Samuel Leeds or any company mentioned. This is commentary and critique, not financial advice.
The UK property market, I believe, is basically finished. In my opinion, by 2030, it's going to be near enough impossible to buy your own property if you want to buy property to live in, or if you want to buy a buy-to-let to make a little bit of money on. I think it's going to be completely impossible.
From the start, the video leans heavily into fear-based language. Saying shit like it will be impossible to buy property by 2030 are strong claims, and there's no clear evidence presented to support that statement. I'm not saying he's wrong, I'm saying he hasn't justified it yet. And this matters because fear-based narratives influence how people make financial decisions, often badly. Let's just see where he goes with this.
The first company I want to talk about is Lloyds Living. This used to be known as Citra Living, and this is owned by Lloyds Bank. They currently own 7,500 rental properties, residential homes in Britain, and their goal by 2030 is to get 50,000. And of course, Lloyds Banking Group are making a ton of money through the banking system by taking our money and giving us a tiny little bit of interest, and that's a big chunk of the money that they use, and then using it to buy properties and push out residential landlords, struggling buy-to-let owners, and also first-time buyers.
Okay, so Lloyds Banking Group aiming to own around 50,000 rental homes by 2050 through Citra Living. Look, it's good that he's at least pointing to actual figures rather than vague claims, even if it is an AI summary. But the growth plans from Lloyds do make you wonder, like, what they know, or why they want to expand so much into that space. That said, perspective matters. There are roughly 30 million homes in the UK today, so 50,000 represents about 0.17% of total housing stock. To me, that doesn't justify panic, but it is a data point worth discussing.
They are part of the World Economic Forum, whose mission by 2030 is that normal people will own nothing and be happy. Meanwhile, they'll own everything and be even happier. And they've got all these conflict of interest companies. And guess who their biggest investor is? Their biggest investor is BlackRock, an investment company who do the same thing, who are also putting billions and billions of pounds into UK residential property.
When you first see that quote, it is a bit of an oh shit moment, but if you go back and pause at the screenshot, you'll see that it's clearly an AI summary rather than the original report or video. And even the summary says that the phrase was a misinterpretation of a prediction, which has become this big conspiracy theory. I think the original article was about shared services for cars, appliances and subscriptions for things. But I don't know, that doesn't mean his concerns about property and housing are invalid, but using disputed quotes weakens his argument, in my opinion.
Now, you might think I'm just taking a pop at Lloyds because Lloyds closed my bank down and they don't like me. Sent me quite a lot of nasty letters.
Nah.
How can you put on your website that you build and sell and build and rent when you've just done that once? Like, that is absolutely outrageous. Why are they not building and selling? Why would they not? If you buy some land and build, you make a bit of profit and sell, why would you not sell? Well, it's because they want to hold, because they want to have a monopoly, because they know that house prices are going to go up. Why would they sell and get a bit of cash? Oh, I made a bit of profit. Well, they don't want cash. Cash is trash. They want assets, not cash in the bank.
He references legal in general and claims that he's researched their developments, so I'll take that at face value. It's one point I do agree with, these large banks and build-to-rent companies holding properties for the long term and not selling them. Is it unfair that massive institutions can hoard housing at scale? Who benefits from this model? This is an institution with billions in revenue who could absolutely help normal people have a slice of the pie without impacting their bottom line too much. Instead, regular people throw money away with rent payments. So yeah, I think that's a valid criticism. But I'll also say this plainly, life isn't fair and the system has always favoured scale and capital. But despite this, you can still absolutely achieve what you want financially with proper planning and budgeting.
Legal and General have 6,000 properties and are aggressively growing. Aviva have 1,000. Lloyds Banking Group have 7,000. Their goal is 50,000. I mean, it's only a matter of time before they genuinely just own all the properties.
Even using those estimated figures, 6,000 for Legal and General, 1,000 for Aviva, and Lloyd's future target of 50,000, it's still a drop in the ocean compared to the 30 million homes in the UK. Is it worth talking about? Yes. Worth panicking over? No. When this kind of language gets used, zoom out. There's still plenty of housing stock, and if owning a home or a few of them to rent out is the goal, the answer isn't fear, it's planning, time, and actually going after it.
Aviva, you know what they did? They would just double your ground rent. Every few years, just double ground rent, double ground rent. They kept doing it. And people's ground rent got so high that they then couldn't sell their houses, but they also couldn't afford to pay the ground rent. And they ended up having to go to court, and they lost. They lost! And they're still the consultants for the government, being backed, working in partnership. It is absolute legalized criminalization. And no one's saying anything about it. It's not in the media. Why?
This example is genuinely shit. It looks like one of many cases where large companies benefit from dodgy legacy contracts. I don't think this is even unique to Aviva, but it does highlight why regulation and property ownership matters.
Let me explain it this way, as if I'm talking to my kids right now, so this should really make sense. It costs these companies, Lloyds Banking Group, when they build houses, costs at least £200,000, maybe even £250,000 to build a small 2-bed house. You can speak to any construction firm and they'll confirm that. A couple £100,000 to build. But you can buy houses in certain parts of the north for 80 grand. They are building houses in estates, spending 200 grand, and then once they're built, they're worth 300 grand. Of course, they're not selling them, they're keeping them. But then you've got an estate just down the road where the same houses that are just a little bit older, you can buy for 80. There is a huge discrepancy between build cost and buy cost in certain areas.
Samuel Leeds is a big name in the space with a long track record in property development, so he's clearly experienced in cost analysis. His breakdown is simple, maybe too simple, but the core idea does make sense. He doesn't go deep into strategies like forced depreciation, refinancing or refurbishment, but we all know that's where his expertise would normally sit. Although, earlier he was saying it's going to be impossible to buy property, but now it sounds like there are estates out there with bargains just sitting there for the taking.
And the rich people create the rules. So all these worrying taxes that might come in, they're not going to apply to you if you set up and structure your companies the same way. And there's nothing stopping you. You can. You can either be a victim and go, oh, it's going to be so hard. Oh, it is so hard. Or you can go, no. We're in the last buying cycle. It's going to be impossible, but it's not impossible now. And you can either complain or get rich. Now, I chose to get rich, and as a result of my wealth, I have freedom, I have time, and I think I'm a pretty good person, and I don't hoard. I don't try and keep a monopoly. I teach, I share, I show others. These guys know that the pound is going to crash.
This is where he's switching it up. Training clips appear more frequently, the language becomes more urgent, he starts talking about his rich lifestyle. No pitch yet, but the seed is being planted. This is serious, time is running out, you need to act. I can tell the close is coming. Just wait. I just want to say again that everything in this video is my personal opinion based on my interpretation of the content shown. I'm not making any factual allegations or accusations against Samuel Leeds or any company mentioned. This is commentary and critique, not financial advice.
I believe you're watching this for a reason. If you want to know how to find properties that are affordable, 60, 70, 80 grand houses that you can buy with other people's money, and how to structure it, and how to buy it through a company so you get the same write-offs that these rich companies get tax-wise, then you can. And if you want to join me, I'm running a free online training explaining step-by-step how to do this now before it's too late.
And here it is, the free webinar. I personally don't like the free webinar model. To be clear, I haven't attended Samuel's webinar, so I'm not accusing him of anything. However, based on my past experiences with similar training funnels, I recognise a familiar structure. Show the problem, show the dream lifestyle, present a simple system, and then upsell paid training, followed by even more expensive one-on-one mentoring. Often, this is information that's readily available online and that you probably already know. Again, this is speculation based on experience, not a claim against Samuel Leeds specifically. You've got to ask yourself why so many high profile names who claim to be highly successful in their industries, whether that's property, trading, e-commerce or whatever, push training so hard. If they're that successful in their industry, why wouldn't they lean into it more? Where is their money really coming from? If you do attend the webinar, just be aware of potential high pressure sales tactics and decide for yourself. And look, if you've got the cash available after making sure your personal finances are in order, then why not consider betting on yourself? I actually like Samuel, I like his energy, and I think he genuinely wants people to improve their situation, but I also understand why he rubs people the wrong way. In my opinion, the primary purpose of this video is to scare viewers, create urgency and induce FOMO, which conveniently funnels into his business model. That doesn't make him evil, it makes him a really good marketer. And to be fair, Samuel is right about one thing. These huge companies are holding land and property at scale, which drives up the prices for normal people. Yet the media often blames people like Samuel or smaller landlords with 1 or 2 properties and convinces the public that they're the problem. But are they really buying up Britain? I don't think so. When you look at the figures rationally, there's more than enough housing stock out there and still plenty of opportunities to make money in property using popular strategies Samuel likely teaches in his courses, many of which you can research and learn for free online. Watch Samuel's full video and decide for yourself, I've linked it in the description. Remember, there are no shortcuts to building wealth, it all comes down to proper planning, budgeting and discipline. Check out my previous video on how anyone can prepare their personal finances to set themselves up for success with a checklist that you must complete before you even think about investing. I break everything down using simple frameworks you can actually apply. It's an old one, but it's solid. Click somewhere on screen to watch that now. But before you go, drop a like if you found this helpful, and if you want more straight up, no BS videos on making money online, hit subscribe and I'll see you in the next one.